Where we have stopped? We have stopped with respect to the, where we have stopped? We have stopped with respect to equity. Is it right? When we have stayed with a little bit very quick review, okay? A very quick review about the equity. What is the most important thing what we have done with respect to equity is with respect to the percentage, okay? If it is between 0 to 20%, it is an investment. If it is going to be 20 to 30%, it is significant influence. If it is more than 50%, you will have the control. Okay? If it is 0 to 20%, it is a fair value measurement. If it is significant influence, we have to follow equity method and we have to follow the consolidated method. Okay, this is with respect to the equity. Now coming with respect to people are there. Is that most of the what we do, people will invest in the bonds, debt, okay? Investment in the debt securities. When we say it is investment in the debt securities in terms of bonds, is that they are very, what is the debt security? Represents a creditor, means they will pay you back, okay? They will pay you back. They will say like this, okay? They will say like this. I'm giving an example, 10%, okay? It is a 10%. Forget, they will say it is going to be 5 years, okay? 5 years. They will say it is going to be bond, okay? Now you will have different things. You will have convertible bond, okay? Convertible bond. You will have non-convertible bond, okay? You will have non-convertible. Likewise, you will have different characteristics. Is it? Now, there is a redeemable bond, okay? There is a redeemable bond. Okay, there is a non-redeemable bond. Okay, non-redeem. These are the characteristics. Okay, these are the characteristics of the debt securities. In addition to the common forms of, don't think that debt. Debt, here we are taking debt in terms of what? In terms of bonds issued by the company, and we are making investment. You are purchasing the bonds. You are buying for them. For you it is an asset investment. For the bank it is a liability. Mandatorily redeemable. Okay, mandatorily. Mandatory means compulsory. It is redeemable preference stock. Stock that must be. Is that must be redeemed. Redeemed means it has to be repaid. Okay, that has to be repaid by the issuer. Preferred stocks redeemable with respect to investors' option. Is that you will have the option. Is it right? You can convertible, non-convertible. You have the option. Is that when they say it is the investor's option, they will issue 10% convertible bonds. Into how many shares? They will say it is going to be convertible into 10 shares. Then you have the option whether you want to convert or you are willing to convert or you are not willing to convert. Collateralized, okay, mortgage obligation. Means there is some conditions will attach with respect to what are the obligation depending on the situation. Is that we will cover into what are the different situations that exist. Is that apart from that, in addition to the common form, you will have different options. What are the investment? There will be a concept of a lease option. Is right? There is a concept of options. Options are nothing but the derivatives. Okay, derivative. There is little bit advanced topic. We will cover in detail. Is that you have the options, you have the futures, you have the forwards are not debt securities. Is that these are not debt securities. It's that these are the, there is, see what they say, you will have the right, okay? You have the right but no obligation. Is that you have the right but no obligation. Where in the debt security, what is there? In the debt security, there will be an obligation. Okay, the difference between here is, here we will have the, if you take into consideration the debt, okay, if you take into investments in debt, there will be an obligation. Okay, whereas with respect to the derivatives, you will not have any you have the right, is it right? You have the right, but you don't have any obligation. This unit applies to all investments in the debt securities. Okay, all investments. What are the different types of investments? Some investments are held to maturity. What they say? They will say it is going to be 10 years. Okay, till 10 years you cannot convert into cash. Is it held to maturity? Till maturity, you are holding debt security. The reporting entity has the positive intent and ability to hold this maturity. Means you are investing till 10 years, you cannot convert into cash. Okay, you can. There are three types of. Some debt securities will be trading. For trading means buying and selling. Your intention is to trade. Whenever the prices will fluctuate, prices will be in your favor. You will sell. When we are talking about the trading, there is a intended to be sold in the near term. Is that we are going? Our intention is to sell. Okay, available sale. Debt securities are not held to maturity or trading. Means any time you are going to sell. Is that any time you will sell? Okay, any time. Means there are three types of categories. One, you are holding till maturity. One, you will sell in the near term. Means if in future, and you will going to sell available sell means you are ready to sell. These are the three different types of security debt. Okay. Now what are the head? Now you can understand very clearly. An investment in debt security is classified as held to maturity when the holder has both positive intent and ability to hold the security until maturity date. Means they will give very clearly what they will mention. They will mention that it is 6%. It is 5 years. Is that 6%? 5 years bonds. Is it now till 5 years you cannot convert it into. You cannot convert. You cannot sell to anybody. There are conditions. Is there? The investor may intend to hold the security for indefinite period. Is that we can say, see, it is held to maturity. Maybe you are forever. People are there. If you are investing in the bonds, okay, if you are investing in the bond, government will issue bonds from the central bank. Is that if they say that they will mention the nature, characteristics, and these are the characteristics and features. Okay, these are the characteristics and features. What they say, they want to sell, hold it for indefinite period. The possibility may exist that it will be sold. The possibility may exist. Okay, they may that it be sold before maturity to supply needed cash. Avoid interest rate risk. In these cases, security cannot be classified. See, there is a possibility. See, there is a possibility that you can sell it for cash. When you need, you can sell it. You will sometimes what will happen? They will say 6%. Okay, they will say 6%. Now, if the interest rate is increasing to 7%, if the interest rate is increasing to 9%, what does it mean? It is good for us or it is not good for us? You are making investment. Keep it in mind. You are making investment and the rate of interest is increasing from 6% to 7%. Is it good for you or not? Is it you are getting the see what when the interest rate will increase? Interest rate will increase when the inflation is increasing. Interest rates will increase when the risk is increasing. Is that neither the inflation increasing is healthy, not the risk is increasing is a healthy. It seems that is that if the inflation increases, if the risk is will increase, what will happen? The present value will decrease. Is it the present value will decrease? Okay, so what will happen? There is a to avoid interest rate risk. Is it right? To avoid that means you cannot assume and presume that rate of interest is increasing. It is good. Rate of interest is increasing. Now assume you have a loan. Is it right? Your bank is giving loan. Bank is giving loan for 6%. Bank is giving loan by 7%. People will take the loan if the rate of interest increases?
No.
No. If the rate of interest is increasing, what will happen? The borrowings will decrease. Is it? See, very logical. You have to think. The subject is you have to think. You have to think what will have impact on the things. Okay. If the rate of interest is increasing, borrowings will decrease. If the rate of interest is increasing, present value will decrease. Okay. Now you have to. People are very much. If assume you have made the investment in bonds. When the bonds 6%, 7% is increasing, means you should think that yes, inflation is increasing, risk is increasing. It is on the face you can say it is 7%. You see the thing. How you will calculate the present value? You know how to calculate the present value? Okay, present value is nothing but the cash flow. Is it right? Cash flow divided by 1 plus R. Take the example. Okay, you take the example of 6%. You take the example of 7%. You take the example of 9%. Okay, you take the example of 9. You understand how that's very important. Is it? You take the example of 9%. Assume cash flow is how much? 100. Take an example. Is that 100? Take the keep calculator with you. 100 divided by 1.06. 100 divided by 1.07. 100 divided by 1.09. How much you will get? Tell me. Yes.
Second one, 93.
Yes.
Third one, 91.
Yes. Now, you see the thing, where the value is, if you are having 100 reals, if you take 6%, where present value is how much? Present value is that what will happen? Present value is 9. If it is 9%, how much is the present value? Present value is less. Okay, present value is less. Okay, means what will happen if the rate of interest is increasing? What will happen if the rate of interest increases? Your present value will decrease. Okay, this is very clear. This will not change. This rule will never ever change. Okay, that is one of the things. Security cannot be classified as held. If the sale before maturity take place, the security is still to be deemed to be held to maturity. What will happen? See, what is your intention of holding the investment? Simple. Whether you are holding till maturity, you are holding till for your held for trading, or you are held for available sale. Everybody will have their own intention. Your objective is different. Your intention is different. Okay, then automatically what will happen? It will be classified as held to maturity. Sale is near enough to the maturity or call date. See, what you are doing, you make it a point. You have made the investment. You have made the investment for 5 years. Okay, you have made the investment for you. Now what is happening? You have completed how much? You have completed 4 years. Okay, 4 years 9 months. Okay, only how many months are left over? Only 3 months are left over. Okay, only 3 months are there. Is that it? 3 months are left. Okay, so that interest rate risk does not have a significant effect on the fair value. Only 3 months have left. What will happen? Nothing will happen. Okay, it will not have any significance. Is that these are the things. If the sale before maturity takes place, sale is after collection 85% of the principal. There is you have see what you have invested. You have invested 100,000 riyal. You have taken 85% you have recovered. Balance is how much? Balance is 15%. What will happen? It doesn't make any sense. Actually, you have taken the core principal amount. The retention amount is going to be only 15%. People see why people will invest. People will invest with the intention of getting the returns. And when you are investing in the debt is less risky. Is it less risky compared to what? Compared to equity. This is the ground rule. Okay, debt investments. Okay, debt investment is less risky. Equity is very high risk. Debt is less risk. That is the reason people will prefer to invest in debt. We'll cover this after some time, how we have to create the portfolio and how we have to make it a part. That means when you are making the investment, you will classify how we are going to held to maturity. Now you understand what is the held to maturity. Held to maturity till the completion of number of years are reported as the amortized cost. Any idea about this?
Amortize is used for non-countable assets.
Your voice is very low. I cannot hear your voice.
I mean that amortizing.
Huh.
This word used for non-countable assets.
It is used for everyone. It is used for everyone. See the thing. Is that understand very clearly. Okay, 5 years. Okay, now you have invested now. Okay, you have invested now. The value will be here. Okay, every year is a 1, 2, 3, 4, 5. Okay, 1, 2, 3, 4, 5. You have this. Okay, you have this 1, then 2, 3. My line is not that much there, and you have 3. Okay. Now what will happen? For how many years you will get the interest? You will get the for after 1 year. Is it right? After 1 year. Here how many years you will be there? It is for 5 years. After 1 year, how many years are left? 4 years. How many years are left? 3 years. How many years are left? 2 years. How many years are left? It is only 1 year. Now a person is having the security. Okay. Now after 1 year, what will happen? The value will decrease. Amortization is nothing but the systematically decreasing the value. Okay, systematically the value is decreasing. Okay, it is systematically 3 years are over. Fine. Now a person you are purchasing from somebody else. You purchase from somebody else after 2 years. Means how much benefit you will get? You will get the benefit for the remaining how many years? You will get the remaining for 3 years. Okay, somebody is purchasing after 3 years. They will get the benefit for how many years? They will get the benefit for 2 years. This is the initial cost, a net of any unamortized premium or discount. Very interesting subject, very interesting topic. Okay, this is the initial cost. Okay, initial of any unamortized one. Now, what is the held to maturity? Any doubt is there? Discuss. It is a held to maturity. What is the how we have to presenting in the balance sheet? How you are going to present in the income statement? How you will present in the statement of cash flows? In the balance sheet, we will say amortized cost, net of any amortized premium or discount, maybe current assets or not. Net of, is it a, you are saying held to maturity. Held to maturity, you will say that value is how much? $10,000 amount. Okay, $10,000. Is that balance sheet? Net of any unamortized way, premium or discount, maybe the current or non-current assets. Is that in the balance sheet? What is the, we'll say, is that you assume that it is going to be how much? 10,000. At the end of the fourth year and the end of the fifth year, held to maturity. Is that held to maturity? Means we are not selling it. We are holding it till the maturity. The value will be the same. With the income statement, interest income, what we are going to show, we will show the, if you are making the investments, you will show the interest income. It includes of any amortization, premium, any what will happen, any amount they have given, any discount is there, we will show it whatever the value of the amount of premium or discount. Okay, what is the value of premium or discount? Any realized gains or losses. If you have sold it in between, if you have sold it in between, we will say whether it is any gains or losses, we will show in the income statement. So as simple as that. As simple as that. In the statement of cash flows, what we'll do, if you are purchasing, it will be a cash outflow. If you are selling, it will be a cash inflow. In which activities we will show? We will show it in the investing activities. Always keep it in mind whenever we are doing this, how it is going to have impact on the financial statement. It is not only in one place we have to take into consideration in all three aspects. Okay, in all three aspects. This is with respect to what? This is with the held to maturity. Are you clear about this? Okay, now, if it is for trading securities, it is you have invested for the trading purpose, buying and selling. Okay, when the things will be perfect, you will sell your intention. Then we are going to say fair value through net income. Whatever the fair value means, how much you are going to get at any point of time. Trading securities are bought and held primarily for sale in the near term. They are purchased and sold frequently. Trading, the name itself says, it is for the buying and selling. The intention is to purchase and sell frequently. Each trading activity is recorded initially when you are making the purchases. Initially means when you are making the purchases, it will be at the cost. Is it? It will be, when we are saying cost, it includes brokerage, commission and taxes. If you are paying any. At each balance sheet date, at the end of each year, trading securities, we are going to again measure at the fair value. Whether the value will increase or value will decrease. At the end of at the balance sheet date. Okay, at the balance sheet date. At the end of the year, it will be measured at the fair value. Now, what will happen is that sometimes you have invested, keep it in mind, you have invested $10,000 in the bonds, okay, in the bonds in terms of, means you are not selling, okay, you are not selling, is it? But what will happen, the value will increase. Either the value will increase to 12,000 or the value will decrease to 8,500. If what is happening, the difference is about 2,000. You are not selling, you are still holding it. It is going to be called as a unrealized gain. Is it? Unrealized holding gains and losses. Or trading securities are reported in the net income statement. Is it? Means it is unrealized. You are not selling it, but you are holding. You will say that yes, this much is the security, the value has been increased. The value of the bond has been increased. Definitely, you will say that it is an unrealized gain. A holding gain or loss is the net change in the fair value during the period, not including dividends or interest not received. Okay, see, there are two things are there: unrealized holding gain and a holding gain. What is the holding gain? What is the change? You see, unrealized means you are not selling. Holding gain is how much? More or less, it are both are same. Okay, a holding gain is a change in the fair value during the period. Is it not including dividends or interest not received? Means what will happen? The value of the bond is the bond value of the bond is increasing to 12,000. You are holding it. Is that unrealized holding gain is for where we are talking in terms of whenever there is a when they are going to not going to be sold. Okay, not to be sold. Okay, these are the things. Is that both are same? Keep it in mind. Unrealized holding gains and losses on trading securities are where we are going to report it. We are going to report it in the income statement as a net income. A holding gain or loss is the net change in the fair value. Okay, net change in the fair value. Now what will happen? Keep it in mind. You have how much is there? You have the first we are recording at cost. Then you will have the fair value. The fair value is going to be 12. Okay, the fair value is 12,000. So okay, now what will happen? Keep it in mind. This is year 0. This is year 1. This is year 2. Year 2 is how much? Year 2 is going to be 13,000. How much is the holding gain here? The holding gain is going to be 1,000. Here if you take into consideration, holding gain is from beginning till the end is how much? The holding gain is going to be 3,000. The holding gain, it is what we are doing when you are talking about the holding gain. We take into consideration only the change in the fair value. It is not, we are not including, is right? We are not including any recognized dividends or interest not received. We are not talking about anything else. We are only talking about the change in the fair value. Now, what will happen in some times? Okay, in some times, value will increases. Is that? See the thing. Take the option. It is 10,000. It has been increased to how much? 12,000. Now, what happens in the second year? In the year 1, in the year 2, what will happen? The value will decrease to 9,500. Which value is decreasing? The fair value is decreasing. Then what will happen? There is a holding loss. We are holding it. We have to only take the consideration of the fair value. How much is the fair value? The fair value holding loss is how much? Holding loss is 2,500. Okay, the holding loss is 2,500. Next, what will happen again in the next year? What will happen? Keep it in the next year it will increase to 11,000. Then what will happen? The holding gain is going to be how much? 1,500. Purpose is that take it down. You are investing in the trading purpose. Okay, you are investing the trading purpose. You will first invest at the cost, and every time at the end of the year you will take the fair value into consideration. When you take the fair value into consideration, either the fair value will increase or the fair value will decrease. It can happen in both the cases, and accordingly we have to take into consideration whether it is a gain or loss. The measurement, the benchmark is what? The benchmark is we have to see what is the fair value. Okay, what is the actual value in the market? Okay, that is why we are saying debt securities. Again, we are talking in terms of the financial statement. How we have to report it in the financial statements. Okay, if we are trading, it is for trading purpose. It has to be shown in the current asset. Short term, okay, if it is going for the short term, it is current assets. You have to report it at the fair value. If it is a trading asset, definitely there will be a interest income will be there. Is that interest income will be there? Is it interest income will be there? Not only interest income, you includes any amount. It includes whatever the plus or minus will be there. Amortization either in terms of premium or in terms of discount. Is that we have to take the interest income based on the market rate. Any in the income statement we have to show any unrealized holding, or we have to see realized gains. Realized gains is what? Realized gains is with respect to the fair value. Unrealized gains is with respect to the which is not going to be case of the sale at the time of the balance sheet date. Is it not? When we do the things, how we are going to show in the statement of cash flow, it is for the trading purpose. When it is anything with related to the trading purpose, where we are going to show, we will show it in the operating activities. Okay, we will show it in the operating activities. Now, I will make a small comparison for you. Okay, I will make a small, what we have done. Is that what see the thing? If it is held for maturity, is that if it is held for maturity, it may be current assets or it may be non-current assets. Is that it is held for maturity? In both the cases, you will have an interest income and you have the realized gain. Is that you have the interest income, you have the realized gain. Where in the cash flow we are showing in the investing activities. Make a comparison. If it is for the trading activities, we have to show it a balance sheet. Trading means for a current asset less than 1 year. Okay, less than, very clearly it is going to be less than 1 year. Okay, we have to show it as a current asset at the fair value. Okay, now where we have to show income and interest income statement, interest income. Is it right? Interest. Here what will happen? Sometimes what will happen? We are intention is to sell, but you will not get good value as such. Then you will not be in a position to sell. Is that you will not be, the intention is to sell. Sometimes it will not happen. Then it is going to be treated as an unrealized holding gain or losses. Only this one is little bit sensitive for our understanding. Where we are going to show it in the cash flow statement in the operating activities. Are you clear about this? Is it right now? See the thing. Now you will have little more understanding about the things. Is that what they have said? They have purchased how many shares? They have purchased 1,000 shares. Is that Maverick? Dates are very important. October 1st. Okay, October 1st, year 1. They have purchased 1,000 shares. Mandatory redeemable. Redeemable preferred stock. Means you can convert into preferred stock. That is the debt securities at fair value. Classify the investment as a trading activity, securities, short term. Okay, trading means it is going to be for short term. Marvick sold all on March 1st, year 2. Is that March 1st, year 2? Okay, now you keep it in mind. Okay, put that timeline here. That makes more specific for us. They have purchased when they have purchased on October 1st. How much they have purchased October 1st? 1,000 shares. Okay, now what they are doing? They are going to say that they are making it on the March 1st. Okay, March 1st. Okay, they have sold all the investment at fair value. The following are the fair values. A redeemable preference stake at the relevant date. How much is the October 1st? October 1st is $15. Okay, how much is the value as on December? December value is going to be 31st December value is going to be how much? $14. Okay, and March 1st, what is the value on the March 1st when they have sold it? It comes to how much? $21. Is that on March 1st? It's not the values are increasing, fair values. Okay, the fair values. It is increased. It is for trading purpose. When it is for a trading purpose, it is for a short term. It is for the short term. No, so many things are going to be there. Okay. Now, what is happening if you take into consideration how many shares they have invested? 1,000. Okay, 1,000. What is the value? 1,000 by one. What $1 is decreased. Okay, $1 is decreased. Okay, when they have purchased it. Okay, when they have purchased it, what is the debit entry? Debit will be the trading securities. Credit will be the cash. Okay, debit will be the trading securities. Okay. Now what happened? Unrealized loss is that they have not sold. Okay, unrealized means they have not sold. Value has been decreased. How much the value has been decreased? The value has been decreased by $1. Okay, the value has been decreased by. It is unrealized loss. Okay, unrealized loss. Is that what will happen? The investments will be reported in the current assets as trading securities, measured at the fair value of how much? 14,000. See what will happen if you take into consideration. Debit will be what? Debit will be the profit or loss. Is it? Credit will be what? Credit will be the investments. How much is that? It is going to be 1,000. The value of investments has been decreased. Okay, the value of investments has been decreased. This is the step 1. This is going to be the step 2. Now, what happens? They have sold it. Okay, they have sold it. What it has been mentioned? See the thing. How much it has been increased. See, this is over. Once we have done this, this is done. Okay. From here to here, how much it has been increased? It has been increased by $7. Okay, it has been increased by how much? $7. When it is increased by 7, means what we achieve. Whenever, keep it in mind, write down. Whenever we are talking about the fair value, okay, whatever the last fair value, okay, last fair value is always valid. We should not take into consideration what happened. If you are saying that 31st December it is $14, then we have to measure with $14. We have measured with 1,000 loss, then that is closed. Again you have to start. This is where it says. We have again I am writing this. Is that this is on 1st October. Okay, this is on 31st December. This is on 1st March. Once it is done, okay, once it is done, it is over. That's all. The next value is going to be how much? The next value is going to be, valid value is $14. We have to take this only. We are comparing with what? We are comparing with 21. Because this has been settled down. The one which is from $15 to $14 is settled. Now we are not closing it down. We have to take 14. What will happen? We have sold it. How much we have sold it? We have sold it for 1,000 into 21. How much is the debit? Will be the cash. Credit will be what? Credit will be the securities. How much is there? 14,000. How much you got the gain? Gain on securities is going to be 7,000. Is that gain on securities will be how? 7,000. Is that cash proceeds? How much you are getting the cash? 21,000. Okay, 21. Gain will be 21,000. Cash is minus the what is the segregation? 14,000 is with respect to the cash proceeds, and the increase in the fair value is how much? Increase in the fair value is 7,000. Okay, increase in the fair value is 7,000. So I just want to make sure. Yeah, are you clear about 2-3 steps? Take the pencil, put it on each and every calculation, understand whether it is clear or not. And debits and credits should be also be very, very specific. Is it okay? Take your time. Okay. Any doubt? Not only here, any time. Okay. Now we are in a very, very serious mode. Okay. Whatever we have that we have to be very specific. Okay. We have to be very specific. Now, available for sale of securities is that it is fair value through OCI. What is other comprehensive income? Is it right? When we are making it a point with respect to the trading securities, what we have done, we have mentioned it very clearly. We have not done anything. Is it right? Gain or sale. Now, what is the next important thing? When we are held the securities for sale at any point of time, we have to measure based on the fair value through OCI. Securities that are not classified as held or maturity or trading are considered available for sale. Means any time sale. Is that you are saying that is on sale. If you are any time it is you can sell it at any point. There is no conditions are there. Initially we are recording at the cost, and at each balance sheet date it will be measured at the fair value. It is measured at the fair value. The importance of fair value should be very. What is the fair value? It is a normal transaction between two parties at the measurement date. Is a normal transaction between two parties agreed on the buying and selling on a normal course of action. Is it? That is the fair value. Okay, you are selling it, you are agreeing, I am buying it, I should agree. That's all, as simple as that. Unrealized holding gains or loss. Now you understand what is the unrealized holding gain. Unrealized holding gain is what? Unrealized holding gain or losses is nothing but $15 and $14. Understand what is that? This is the unrealized holding gain. It is I will write here. This is unrealized holding gain. A holding gain or loss. Is that this is the realized holding gain. Okay, realized holding. That is the moment you put that timeline, it will be easy for us to understand what is the unrealized and what is the what it says. Unrealized holding gain resultant from the measurement of fair value. Where we have to report it? We have to report it in the OCI. OCI is what? Any idea about OCI?
Comprehensive income, that's for trading.
Yeah.
That's the thing after deciding that the next process or no.
Yes, it is not. See, it is not. It is a part of your income statement. We are going to show it separately, which is not part of the trading activities. Tax effects are recorded directly. Anything, you have any gains are there, on that gains, any tax are there you have to pay, you have to record directly to the OCI. Amortization, is there any decrease or increase in value? Amortization of discount or premium is reported in available of securities in an or an allowance to interest income. Is there any value? Interest rates are changing. Okay, interest rates are changing, should be reported on available of sale of securities or any allowances for losses and to the interest income. Is that should be shown in where? Should have to show in the means you are keeping it separately exclusively for the OCI. Receipts of cash dividends is any you have received any dividends should be recorded as a dividend income. All the part of unrealized gains and losses. Again I am saying unrealized gains or losses is $15 and $14 for available for sales of security designated and qualifying as a hedge item in the fair value hedge. Any idea about this statement, yes or no? Hedge item in a fair value hedge. Is it simple? I will just wait. I will check what is the fair value hedge. Hedging is nothing but covering the risk. Is that hedging is nothing but the cover. Now what happens is it right? What they say? All or part of unrealized gain and losses for an available for sale security designated and qualifying as a hedge item. See what will happen. See what you will do. You have invested in a bond of $15. Okay. Now you will say that you will pay some premium. Okay, you will pay some premium, and when paying the premium, you will lock the value. You are covering the risk. It is like an insurance. Okay, it is like a insurance. When you pay for the insurance, it is like you are covering the risk. Yeah, you are paying your car insurance. Okay, you are paying when you pay for a car insurance, you are covering the risk. Whatever the value in case, unfortunately, if something happens, what you will do, you will pay the excess amount of 50 and you will get the things done. Okay, you take that. That is what we say. You are not going to pay more than that. Here, if you are making any investments, okay, investments are very risky. If you are making any investment, if the value is decreasing below 15, you will get 15. Okay, that is the fair value hedge. You are going to get it at a 15. Is that you are not going to lose it, but for that you have to pay some premium amount. If the value is increasing, you will get the total, whatever the value that exists, you will get that value. But if the value is below 15, you will not lose any amount. Is it? That is, we are talking about in terms of fair value hedge. Are recognized in where we are recognized means even the value is decreasing from 15 to $14. You will not lose. Okay, you will not lose. You will be covered with respect to the risk, with respect to the $1. Is that is part of your hedging. The hedging means covering the risk in case the value is fluctuating, and most importantly when the value is decreasing. Is that when the value is, I gave you the simple example of a car insurance. I will not say it is point to point, it is similar to that concept as such. Are you clear about this? Now, again, what they say, see the thing. Here, what we have added OCI. Is that we have added. Now, if it is held for trading, available for sale, if it is available for sale, you can first you have to give preference to current assets or non-current. Available, see it is available, so I say sometimes it will be sold, sometimes it will not be sold. You are saying that I want to sell some securities. Maybe it will take sometimes 6 months, it will take sometime 10 months, it will take sometime 2 years also. We can sell it, we cannot sell it. So you have to make first it is current asset, next it is a non-current asset. Always it has to be reported at the fair value. Equity section, unrealized holding gains and losses reported in accumulated comprehensive income. These are unrealized holding and losses. Again I'm saying 15 to $14 or 15 to $17 also. I am giving an either the value will increase or the value will decrease. It should be where we have to report it. We have to report in OCI. Realized gains and losses. Okay, income statement. What will happen when we are selling it? Is that when we are selling it, what will happen? We are selling it from $14 to $21. Is that any we have sold it? That is a realized gain. Interest income. Any interest income we have received, we have to show that interest income and the realized gain and losses in the income statement. The unrealized gains and losses should be in the OCI. Okay, unrealized. What is the unrealized gain and losses? $15 to $14 or $15. Maybe there is a possibility that it will increase also. Okay, either it will be a gain or it will be loss. Okay, in that is we have to show it in the OCI, unrealized gains. Okay, and if it is realized gains, done. Okay, it is realized. We are closing the whenever we are closing. Okay, we have to show it in the income statement. Whenever we are going to continue, okay, continue with no selling, then you have to show it in the OCI. And in the invest statement of cash flows, either it is a cash outflow or it is a cash inflow, we are available for sale. Okay, we have to show it in the investing activities. Is that there is held to maturity? Is it held to maturity? There is a concept of trading securities held for trading, or it is held for available for sale. Is it okay? Just have a look. When you are doing the thing, you will find so many interesting things. Okay, very closely affected. Make it a point. What are the characteristics of the held for maturity? What is the characteristics for trading? And what are the rules for? In all the cases, we have to make sure. Okay, we have to make sure where it is going to be reflected and where it is going to be presented and at what way it has going to be presented. Is it in if it is available for sale, it is for fair value. If it is for trading purpose also, it is going to be for the fair value. Okay, it is for trading purpose. It is if it is for the held to maturity, we have to show it after every year, whatever the value at the end of the year, it is going to be called as a amortized cost. Okay, these are the most important things which you should be understand. Are you clear about this? What is the impairment? What is the difference between most important thing? Is that what is the amortization? Okay, what is the amortization and what is the impairment?
Oh yeah, impairment for the natural resources. It is used for natural resources like oil and gas. Deducting the cost of it.
Is it? See, amortization means amortization will have the life, okay, for 5 years. If it is asset life is 5 years, then we say amortize. Systematic decline. What I told you about amortization, it is going to be a systematic decline. What is the impairment? Impairment is we don't have, it is an indefinite life. Okay, indefinite. Every year we will calculate. Okay, every year we will calculate. We don't know whether it is for which type of assets. It is the asset which is having a indefinite life. Okay, it will have a indefinite life assets. Okay, unrealized. Now, unrealized changes in fair value are recognized in earnings if they represents a permanent decline. Okay, now what will happen? It is going to be 15. It is going to be permanently. It is going to be 14. Impairment. Okay, impairment. There is a permanent decline. There is no further options of increasing the value. Okay, the increase. The amortized cost means amortized cost basis means the value which has been decreased from year to year. The amortized cost basis is used to calculate any impairment. Is that amortized? See what will happen? I am putting the timeline. Okay, first year. Okay, it will decrease. Is it a permanently? It is decreasing. Is it decreasing? What it is decreasing permanently? Is that it will not go up again? Is that it will not? Another year it will be there. It will be decreasing. Okay, it will be decreasing. Another year it will be there. It will be decreasing. Is that it will not go up. Okay, it will decrease permanently. For it, and it is doesn't have the definite life. It will see what will happen. They will say that they have invested in bonds. Okay, if you take into consideration the equity doesn't have any life forever. Okay, ownership will change from one person to another person. The value, the asset will be there forever. Land, see the land. Okay, land will not be an impairment, but I am saying an example of land. Land will be there permanently. There is no finite, there is no fixed time frame for the land. The amortized cost basis differs from the fair value, which equals to the cost basis plus or minus net unrealized holding gain or loss. Is that, see the thing, which equal to the cost basis. See, what is the cost? Cost is going, assume cost is going to be 10,000. Is that cost is going to be 10,000. If now what will happen? There will be an increase of 2,000 or there will be a decrease of 1,000. We will not give the impairment will not come in a more positive way. Impairment will come in a negative way. Okay, impairment will come in a negative way. If the value is decreasing, based on what? Based on the amortized cost. If you take, what is the amortized cost? Amortized cost, this is the amortized cost. See, 15 is the value. Now value is going to be how much? 14. Okay, this 14 is a amortized cost. Is that what is the correct? See what we are doing. Fair value means increase. We assume that fair value is positively increasing, whereas amortized cost is nothing but negatively decreasing. If you, in simple words, if I can put it in the very simple explanation, fair value we take it positively, it is increasing. Impairment is nothing. Amortized cost is nothing but the decreasing. If a decline, that's what is it. if a decline in the fair value of the security held for maturity or available sale below the price, below 10,000, okay, below $15 basis is permanent, means it will not go up, it will go down only. Once it is went down, it will not go up. The amortized basis is returned to the fair value as a new cost basis. Is that what happens if the value is going to be down from 15 to $14? Then what is the current value we will take? We will take the current value as 14.
Sorry. The line is cut.
Pardon?
No. I don't know. The line is cut. Sorry.
Pardon?
No. The line is cut. Then it's cut. Suddenly. Sorry.
Again, please tell.
Yeah, I mean the net is cutting.
Internet is not cutting, is not there.
I don't know. With me, it is cut because I don't know. It is cut suddenly. Now I am going.
Now it's clear to you.
Now it is okay.
Okay. Now what what is the amortized cost? Amortized, when you are making the investment, okay, when you are making the investment, every year you will calculate the value, okay, every reporting date indefinitely. Now the value is increased. Take the example, the value is decreasing from 15 to 14. The value is decreasing from, what happening? The value is decreasing. We will take the current value only. We will not take the, okay, we will take the current value. How much is the current value? $14. This is the amortized cost. Amortized cost. When we are making the investments, if the value, see what happens, we are talking about the investment, the value will decrease. Over the rate of interest is increasing. Is that the rate of interest? If the rate of interest is increasing, what will happen? The present value will decrease. The present value will decrease. There are so many things are there. How the investments will work. How the investment, you are making the investment with respect to the bonds. When you are making the investment with respect to the bonds, as you are talking in terms of a premium, okay, as it talks about the premium, or we are talking in terms of the discount. What is the premium and discount? You should make a point as such, okay. See the thing, value is how much? Value is 1,000. If you are going to buy it at 1,500, you are paying how much premium? You are paying more. You are paying 1,500, but how much you will get? You will get only 1,000. Keep it in mind. You are paying 1,500 for the investment, but at the time of maturity, you are getting how much? You will get only 1,000. Now, see what is the bond? Rules of bond is different. Is that there is a inverse relationship, there is a opposite relationship. If you are going to say that 1,000 bonds is there, I am paying how much? I am paying 900. I am paying $900, but I am getting a bond value of how much? This is the cost. Getting a bond value of 1,000. At the time of maturity, how much I will get? I will get 1,000. I am paying now at 900, but I will get 1,000. Is that this is what they say? When we make it a point, you are saying that if the value is declining, you are making an investment. If the decline in value of individuals held to maturity or available for sale, is that you are held for maturity. You are making an investment in the bonds and your intention to held to maturity or available for sale. And the value is declining. Is it that the value is declining? Then what will happen? And once the value is declining, it is happening on a permanent basis. Means again there is no recovery. Okay, once it is declining, it is declining. Then it has to be returned down to what? It has to be returned down to fair value. Is that on a new cost basis? Okay, on a means what is the new cost? New cost is going to be $14. The values are decreasing. You see the thing. Once the value decreases, again you cannot say that I can change the value. Is that when we are working with the fair value, simple concept, we can, once it is done, again we cannot go back. Okay, we cannot go back. See the thing. Once it is how much we have done, $1 done. This is closed. Then next what happens? The value has been increased. Then which one we will compare? We will not compare with $15. We will compare with whom? We will compare with the $14. Understand, the most important thing is concept of understanding the fair value. I cannot say that I have invested 5 years back. No. What is the last value on the reporting date? That value should be taken into consideration. Impairment, value is decreasing. Is that value is decreasing on a permanent basis? Okay, value is decreasing on a permanent basis. The impairment is the realized loss, including in earnings. Any value has been decreasing, because if we are doing it on a what basis? We are doing it on the fair value basis. Done. We have to show it that $1 as a realized loss. Then again, the new cost basis is not affected by recoveries in the fair value. The new cost basis, how much is there? It is going to be $14. And now what happened? The value is increased to how much? $21. Okay, dollar. It means the new cost is not affected. Is it right? It is not affected in the recoveries. That means you cannot say that I have incurred a loss of $1 last year. I have to consider what $1. No. What happened last year? That is gone case. That is the gone case. You have to take the recent value. You have to take the recent. Subsequent change in the fair values available for sale securities, except other than temporary declines. If there is any change in the values, in the fair value, any change in the fair value for the securities, where we have to show it in the OCI.